Okay, welcome everybody. I hope everybody can hear me all right. Happy Wednesday. Let's get the meeting started for today. It's already the end of March. That is crazy. Let's get started. There we go. Zoom people, can y'all see the screen? Yes, perfect. So our agenda for today, we got quite a few topics to cover. We have a new social event coming up, elections to talk about, and a little congratulations to the graduating seniors for the semester. So we're gonna have to order the souls. And any outperforming moments to start off the meeting in. At least 3 today. MDs, anybody? Go for it.
Got 100 on my map.
Nice. Round of applause. Congrats. Everybody's so wise here. Yes.
I completed onboarding for JP Morgan. I start on the 18th the next month.
Anybody else? Even on Zoom, you could type it out and I'll read it for everybody. Oh, yes.
I've been keeping up with my studying habits and I've been doing pretty good in tests.
Good job. That's a good one. Definitely good. And our quote for today is, if you don't risk anything, you risk even more. And to me, this quote is like a rewritten version of, you miss every shot you don't take, right? Something like that. I don't remember, but that one, but I like this terminology better with the whole risk term, because risk is like, oh, losing money from investments or being scared to do something. So take the chance. If that opportunity arises, why wouldn't you take it? And sign in, of course. We are still doing the $25 gift card raffles. Definitely sign in if you're in person, and hopefully you win a gift card at the end of the meeting. 2 winners, like always. Thumbs up when you're done scanning and signing in. And I am asking a simple question again in the QR code once you scan it. Everybody good? Okay, yes, perfect. So Brendan's gonna come up real quick to talk about our next social event. Round of applause for Brendan.
All right, what's up, guys? So on Monday, April 4th, we're gonna have a social at the library. So it's just gonna be a basic study/game night. It's gonna be super relaxing, nothing too intense, obviously. So yeah, just coming out, just hang out for like an hour or two, and yeah, we'll specify the details later as per the room or where we're gonna be at. But generally, right now, it's just decided it's the library. But yeah, that's it.
Cool.
Thank you for that, Brendan. And there will be snacks. That's why I asked y'all in the sign-in sheet what snack you like during studying. I personally like chips, so hopefully there'll be chips there. And now for Anthony with the market outlook.
Good evening. All right, so we got our markets. We're going to go over some selected earnings. We're going to cover a little bit of news. I'm going to cover my weekly reading and then an update on the Market Watch competition. And so the S&P 500 snapped its 4-day win streak. It broke 4,600 for the first time since January. The VIX is down for the first time since January, as we can see from our wonderful Bloomy graph that all markets are up except for US small cap. And as well as oil's down. We know some of the story there. Here's our price change year to date. We can see year to date, the markets are all down with the NASDAQ at 6.6 being the most. And we can see that oil is up 42%. Here's our price change for the last 12 months. That's looking a little better. We can see all major indices are up. Please mute yourself. Except for the Nike and developing markets and emerging markets, excuse me. That's down to negative 3.1%. Here's our sectors. We can see from this graph that all sectors are up with real estate at 5%. Here's our price change year to date. Energy is up 38%, followed by utilities. Communication services being the biggest decrease. Price change last 12 months. This tells a different story. We can see energy is up 55%, followed by the technology industry at 24.1. Here's our sector heat map. We can see Berkshire B is down 1.24%. JPM.
Is this one day yesterday?
Yes, sir. I usually grab these. I believe it's off of finviz.com. I was going to share with everybody all the URLs and websites I like to keep up with, and that I kind of build myself out for the week to get notifications, but I'll provide that next week or on Discord. Usually it's Earnings Whisper, FinViz, Stock Twits. And so here's some of our crypto. This is a good turnaround story right here. We can see for the last 7 days, all of these cryptocurrencies are up, except for USD coin, which is flat. We can see from the last 7-day graphs that they have been gaining. I hope to next week kind of go into further and kind of explain how the different market caps and the volume and the circulating supply. If you take a look at the Tether, about how large of a volume they have right there, that's 82 trillion. But look at the price, and then if you see some of the other ones that are trading at 2 trillion. Trying to figure out some of the story going on there. Here's our most anticipated earnings this week. So we got some real good ones. I love McCormick, Lululemon. Where's JC at? What's your favorite one? Come on.
Dude, you gotta go with Chewy.
Chewy. That's right.
Pet food.
Can't go wrong there. I need one more. Academy, that's right. And so I'm assuming they did pretty good out of all this COVID.
We're doing pretty good.
And so here's the actual earnings report. So we got Chewy. They missed on EPS, and they missed on Rev. We got Micron Technology. They beat on both. Lululemon, they missed on Rev. We got RH and PVH Corp. I tried looking into more of that surprise, JC, but I believe it's just analyst sentiment. And so here's some of the companies coming up next week. Acuity Brands, Lindsay Manufacturing, Cognite, Smart Global Holdings, and Green Organic Dutch Makers. And so with a lot of the political turmoil going on and different things going on with markets, I started to look into the commodity of nickel. And so Russia accounts for 17% of the global production capacity for class 1 nickel. And nickel is very important, as we know, in the future of EVs and the evolution of our laptops becoming thinner and not getting hot on our beds. And so here's the current price for the commodity of nickel. It's at 32,724. We can see, wow, it's had a big jump within the last month. Major dips. And another reason for this is our government plans to invoke some Cold War powers, as well as this will make things much harder on Russia, as well as the commodity in general. Tesla, that guy always seems to stay ahead. It looks like he's well prepared in advance for this. And so the S&P says that there's a forecasted growth rate of 7% over the next 5 years. And they're predicting 35%, a major jump in the next decade. I didn't know that most, 70% of nickel is actually used for the stainless steel sector. So it's not that important or being used for batteries at the moment, but as we can see, that's scheduled to change. And so we're going to talk just a brief moment on Berkshire Hathaway, on the difference in the two stocks. You got the tickers BRK.A, BRK.B. BRK.A is the original stock for this firm. As you can see, the current price of it is $536,000. And then Berkshire B, I believe this one's more attached to real estate. It was launched in 1996. It's currently trading at $357.61. There's some minor differences. I believe some of the other directors will cover it later. And so in this weekly reading, they touched on the differences in technical analysis and fundamental analysis and how they play into the castle in the air theory and firm foundations, as well as growth rates and how they play into pricing and earnings, and how a company actually makes you feel can actually change investors' actions. And so if you care to find out, please go read the book yourself. And so for our Market Watch competition, these are our prizes. It's at the end on the 20th. It's coming up pretty fast. So these are the current rankings. You got Andrew tearing it up at the top. We had a lot of new people come in. I believe there's 15. Some of the NAs are just maybe waiting on their trade to go through. But I checked that at midnight and it's already changed from now big time. And as always, every Thursday, if you'd like to join us in the FSC, we'll be learning Capital IQ. Thank you very much.
So today, from my economic perspective, I'll be covering Berkshire Hathaway. I'll be giving a quick economic perspective over the company. We're going to take a look on their view on real estate, which is very interesting. And lastly, I have a documentary recommendation. So firstly, Berkshire Hathaway is currently operated by Warren Buffett. Took over the company in 1965. It was founded in 1839. Their employment in 1965 was approximately 2,000 employees. And in 2021, they have approximately 372,000 employees. Their main economic contributions are the purchasing and relatively passing holding of common shares and bonds, the control, management, and growth of numerous businesses, and the selective allocation and reinvestment of Berkshire's earnings. So we're going to take a look in this slide of what BRK.B currently is. This is the stock that is currently purchased, or it's currently priced around $300. And the top holders right now are Warren Buffett, holding about 0.01 of BRK.B. He's got 38% of Berkshire Hathaway as a whole. We have Ronald L. Olson, Merrill Whitmer, both holding very small amounts. But then those are just the individuals. We see Vanguard holding about 6%, BlackRock at about 4.5%, and State Street Corp at about 3.1%.
I'm Bob Klein from Los Angeles.
Sorry, guys, I didn't mean to play this. So this is their view on rental properties and why Berkshire Hathaway doesn't purchase them. Personally, I've been wanting to learn more about real estate properties and rental properties. And I found this view very, very interesting. So I'm just going to play this video. I'm going to play most of it and ignore the clickbait title. He doesn't actually hate investing in real estate, but he's going to share some views on it.
I wonder if you could give us a glimpse into your investment process, the way you approach looking at a particular industry. And I wonder if you could use real estate as an example. I know real estate hasn't been a huge part of Berkshire's portfolio over the years. And I wonder if that's because you view real estate as a commodity business, or if maybe the cash flows from real estate tend to be more predictable than perhaps from some other industries, and thus tends to be less likely to be mispriced and therefore less likely to find terrific bargains in real estate. So,
Go ahead.
so just wondering if we could, if we were watching a discussion between you and Charlie hashing out the merits of real estate, how it would go.
Well, it would go like all our other conversations. He would say no for about 15 minutes. And I would gauge by the degree to which the motion he put into his nose, whether he really liked the deal or not. But we both had a fair amount of experience in real estate, and Charlie made his early money in real estate. The second point is the more important point. Real estate is not a commodity, but I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time. Now, during the RTC period, when you had huge amounts of transactions and you had an owner that didn't want to be an owner in a very big way and they didn't know what the hell they owned and all of that sort of thing. I mean, you had a lot of mispricing then, and I know a few people in this room that made a lot of money off of that. But under most conditions, it's hard to find real estate that's really mispriced. I mean, when I look at the transactions that REITs engage in currently, and you get a lot of information on that sort of thing, you know, they're very similar, but it's a competitive world, and you know, they all know about what a Class A office building in Chicago or wherever it may be is going to produce. So at least they may all be wrong, as it turns out, because of some unusual events, but it's hard to argue with the current conventional wisdom most of the time in the real estate world. But occasionally there have been some, there could be big opportunities in the field, but if they exist, it will certainly be because there'll be a lot of chaos in real estate financing for one reason or another. We've done some real estate.
So he goes on to discuss mispricing of real estate for an extensive amount of time. But the main takeaways of why Berkshire Hathaway doesn't purchase rental properties, and especially Warren Buffett and Charlie Munger, who is currently chairman, is number one, no competitive advantage. They feel that they don't know enough, as many of these people purchasing these large apartment buildings do. Reason number two is the lack of mispricing. He says that mispricings in real estate are rare, and compared to the REITs that he purchases through Berkshire, he says it's easier to find mispricings in the market as compared to real estate. Reason number three is a corporate tax disadvantage. Purchasing REITs are exempt from corporate taxes, and real estate for their corporation will be taxed more heavily. The last reason is management and scalability. A common misconception that investors have when purchasing rental properties is they kind of assume that the income will be passive rather than active. Some things that I found in my own research of rental properties is you're gonna have to deal with the 3 T's, which are tenants, toilets, and trash. Most people kind of assume real estate is something that you go into very passively when it takes a lot of work to get in. So the top REIT that Berkshire Hathaway currently has is Store Capital. The ticker is STOR. You can see the chart right here. It's set to a 5-day measurement. And right now, Berkshire is about 0.25% of Berkshire Hathaway's portfolio, or nearly 10% of the outstanding store shares. Lastly is my movie recommendation. Normally it's a documentary recommendation. This time I went for the movie recommendation, just because we're on the topic of real estate. So a great quote from this movie is, "You don't build an empire off of a 1.4% cut of a 15-cent burger. You build it by owning the land on which that burger is cooked." I found the business model behind McDonald's very interesting, as they own most of the franchise's properties that the McDonald's is built on. And I don't know the exact number on it, but I know McDonald's is a top real estate holder. That's where a lot of their value comes from. And it's a great movie. It's very easy to follow, and it's very informative on their real estate empire that they've created. So if you'd like to connect, my QR code, or my LinkedIn is on a QR code. Or if you have any questions about the sources or anything else, feel free to email me or talk to me after the meeting. I'll be sticking around.
What's up? So today we're going to talk about Berkshire Hathaway. No surprise there. Okay, so first we're going to talk about early life of both Warren Buffett and Charlie Munger. Warren Buffett was born on August 30, 1930 on Omaha, Nebraska. And an interesting fact is that with a 3-year difference, both Charlie and Warren worked as shelf boys in Warren's grandfather's store in Omaha. And both didn't like working there because they wanted to make money and they thought they were not getting paid as much. By 15, Warren Buffett bought a farm in Nebraska with a tenant who would work the farm and give half of the profits to Warren. That farm was $1,200 back in that day. By 16, he graduates high school with $50,000 in savings. And that's adjusted to today's money. Buffett deeply admired Benjamin Graham, author of The Intelligent Investor, and we'll go deeper onto him as we progress. One interesting fact is that since Benjamin Graham was a professor at Columbia University, and that's why he went to Columbia University, he was also rejected from Harvard. Benjamin Graham, the partnership owned 55% of Geico. In 1950, Warren put 75% of his portfolio on Geico, and in 1952, he sells it for $15,259, a 50 internal rate of return. That's something Warren Buffett did in his early life. He didn't invest for the long run. He would buy and sell stocks. He would buy them for like a year or two, and then he would sell them. Now let's talk about Charlie. Charlie was born also in Omaha, Nebraska, 1924, 6 years older. For his undergrad, Charlie went to Michigan State, where he studied math and physics. After Pearl Harbor, he enlisted in the Air Force, and after IQ testing, he becomes one of the highest scores in the military's history. After the military, he applies to law school at Harvard in order to be a lawyer like his grandfather, and he graduates top 2% of his class. By this time, Charlie meets her wife, has a kid, and moves to LA to practice law. He always wanted to live in LA. He just liked LA. He liked the weather, and he also thought that LA was a bigger city than Nebraska, so he thought he could be. He wanted like to be famous, not famous like as an actor, but like he wanted to be known, and he thought that if he went to LA, he would be known more than in Nebraska. Sadly, his kid passed away in 1955, and he gets divorced. Later, he says to himself he wants to diversify his business activities. He was a great lawyer and decides to get paid in equity as part of his services. He was working with a guy that had a mine, and then he told the guy, I want you to pay me in stock now. Additionally, during this time, Charlie's investing a lot in real estate. Now let's talk about Ben Graham. Ben Graham was Warren Buffett's mentor. Also, he was one of the pioneers of investing. Let's talk about what did Warren learn from Ben Graham. One of the things, he obviously learned a lot, but this is one of the things he learned, and we'll talk about, is cigar butt investing, or how I call it, extreme butt investing. That's how I call it. You can call it cigar butt investing. Okay, so what does that mean? Ben Graham looked for companies where the book value of the assets, the cash on hand, the value of their land, property, and buildings were worth more than the stated value of the company. So if the company was worth 10 million, but they had a building land that was worth 15 million, Ben Graham wanted to buy that company and then sell everything so he would make 5 million. If he sold everything, would he make money? That's what he looked for. And he didn't even care if the company had cash flow. So if it had employees, he just wanted to buy the company and sell the physical assets. And why did he think like that? Okay, this is a quote. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. So obviously, one of the things Ben Graham was a value investor, and that's something that he influenced Warren Buffett a lot during his investing days until this day. But okay, so let's move on. Benjamin was a part of his environment. He invested during years of depression and war, which caused the stock market to stay relatively flat. That's why he invested that way. He didn't learn to invest for the future or like long term. So let's talk about stock market returns. In 1928, if you started with $143, by 1937, you have lost money. You have had $94, and by 1943, you would have 139.59 cents. So you lost money just investing in the stock market. So that's why I'm talking about the environment that made Benjamin Graham invest the way he did. Okay, Ben Graham said that Warren was his best student, but he only hires Jews. So he didn't hire Warren after college. They still send letters to each other regarding financing stocks. Years later, Graham decided to break his rule and he hires Warren to his hedge fund. Within 2 years at Graham Newman, Warren becomes extremely important. He comes up with all the investing ideas and Graham oversees them. Graham retires and offers Buffett to be a partner. Graham retired and he moved to California and he wanted somebody to lead the partnership so he could still make money. So he asked Buffett to be a partner, and what did Buffett say? Warren declines. He wanted to start his own fund. Buffett partnership. Okay, this in 1957, Buffett begins investing friends and family's money. He quickly is managing by himself over $1 million. And then he wanted to do that from Omaha because he liked Omaha. Obviously, he still lives in Omaha, so he likes Omaha. And there was a doctor there that had a lot of money, and he was the biggest investor at that time with Warren. And he's the doctor that tells Warren that there's another guy that's pretty smart. And that guy was Charlie Munger, and they met 3 years later at a dinner. Okay, so these are Warren Buffett returns in his partnership. The first year, that Dow was negative 8.5%. Warren came out with 9.5%. Second year, 41% return. Third year, 26%. Fourth year, 33%. By 1961, more people wanted in, and he was managing over $7 million, more than Graham ever managed in his entire career, and in just 4 years. From 1957 to 1968, the Buffett partnership earned 31.6 annual return with no losing years, compared to 9% that Dow was providing year over year. Now, this is a great graph. In 1957, if you had put $100,000 with Warren Buffett, you would have 1.7 million in 1969, and obviously 250,000 with the Dow. Now, this is one of the best trades Warren Buffett did whilst having this partnership. In 1962, Amex is one of the most trusted financial services firms. However, that year, Amex was liable for a fraud case that expected them to pay $150 million. The stock dropped 50%. Warren learns about this and begins reading on Amex. He also traveled to New York to ask other analysts what they thought about Amex, and he comes up with a decision. He puts $13 million out of the $17 million his fund had on Amex. Next year, Amex pays only $60 million and the stock 2.5x's, and he sells all his shares. That was one of the best years in the partnership. Now let's talk about Berkshire Hathaway and how it started. In 1964, Warren hears about a stock trading for 50% less than its book value. It was Berkshire Hathaway Textile Mills. He decided to buy some stock and he buys shares at $7.50. There was a man named Stanton who came from a family of textile manufacturers. He wanted to save the textile industry in Medford, Massachusetts. And he wanted to buy, he wanted to control the textile industry in that city, so he starts buying stocks. Stanton starts buying Berkshire stocks so he can control the company. Warren is happy as the stock is going up. Warren talks to Stanton, who wants to buy more shares and agrees to sell his shares for $11.50. Warren goes back to Omaha and Stanton sends a letter saying he agrees to buy them for $11.38. So he lied. Warren gets angry and decides to control the company and kicks Stanton out. And what do I mean by control the company? He buys 49% of the company in deciding shares, and he would buy the stocks for around $14.35. Some say since his father passed away, he was emotional, and that caused him to get angry for 12 cents. And he was also an honest guy, so they also say that he rubbed him the wrong way. In 2010, Warren said that buying Berkshire was the worst mistake of his investing career. He asked that if he had bought the insurance company, which I'll talk after, he would have made over $200 billion in additional returns. Now let's talk about float. Float is one concept that Warren Buffett thinks is nothing. He credits float as the most important concept during his investing career, and float has to do with insurance. Float is the money that an insurance company holds between the time customers pay premiums and the time they make claims of their policies. There's a quote, Buffett, we can do almost anything with insurance float. He learned about float in 1950 when he spoke with Geico CFO. Like I mentioned, back in 1955, he bought some Geico shares because Benjamin Graham owned 55% of Geico, and that's where he met the CFO, and then he talked for 5 hours with the CFO. And that's where he learned about float. Another interesting thing about float is the money under float has 0 interest. Like instead of asking a bank for money, there's 0 interest on float and there's no collateral. Warren Buffett has created the idea of float as a major catalyst for success. Now, this is the insurance company that he bought. So I don't know, I wanted to explain again, float. So whenever you have float, you can invest that money onto other companies. And that's how Warren Buffett has created his empire. He buys insurance companies like Geico, bought Geico in '96, and other insurance companies, and then he uses that money to buy other companies and to finance other stuff for no interest and no collateral. In 1967, he bought insurance company National Indemnity. He used the flow to invest in the Berkshire Mill and would then use the cash flow from the mill to pay insurance claims. He would use this strategy throughout his career to buy other companies. Additionally, in 2020, Berkshire Hathaway had the largest float in the world with 138 billion. Now let's talk about the company he bought last month, which is called Allegiany. Allegiany owns and supports certain operating subsidiaries and investments anchored by a core position in property and casualty reinsurance and insurance. So it's basically another insurance company that works with float. That's why they bought it. They also had a great deal on it. In March 2022, Berkshire Hathaway had 144 billion cash sidelined. In the 2022 annual letter, Buffett and Munger wrote, "Little excites us regarding acquisitions." That's why they didn't spend their money. However, this deal is something Buffett is familiar with, and they're paying 1.26 times Allegany's book value, which is pretty cheap as he's a value investor. Allegiany is also a conglomerate. It's the same business model as Berkshire. They own a steel company, a funeral services firm, a toy maker, and it's all based on their cash flow from their insurance business. Berkshire will be the perfect permanent home for Allegiany, a company that I've closely observed for 16 years. So I guess it was time to buy it now. Now let's talk about the price chart. The acquisition in total was 11.6 billion or $848 per share, a 16% premium on Allegany's average share price on the month of March. A year ago, Allegiany was worth $633. The day before the acquisition was announced, $676. The day of the announcement, it rose 25% to $844. Now Berkshire's chart. A year ago, $382,697, 560 billion in market cap. The day before the acquisition, 500,000, 512,000. And the day of the acquisition, it rose 2.5% to 525,000. Also, Berkshire Hathaway moves less than the market. It has less than the S&P. It has a lower, the S&P is the beta, but they move less than the S&P, so they have a beta less than one. So yeah, the movement is not that big. That's it. Feel free to ask questions regarding internship. And now with Mr. Sweet.
All right, how y'all doing? Good. All right. So I keep getting questions about the yield curve and recessions, and I'm 100% sure that we will either have a recession or not have a recession. That's what I'm betting on. But the key is, how well is the bond market and the stock market forecast recessions? So I went back as far as so the first recession, I got data back to the early 60s. And so the first recession in the 60s was 1969. Then there was one in 73. That was a pretty bad one. 1980 and 81. Those were the two vocal recessions. 1990, a pretty minor one. 2000, 2007, two major ones, the dot-com crash, and then obviously the financial crisis. And then the really, really short recession, the pandemic recession, which kind of came and went really, really fast. And so what I did is I looked at, okay, so the spread, what's the spread? Traditionally, it's the 10-year treasury minus the 2-year treasury. Usually the 10-year is about 0.7% higher than the 2-year. But if the 10-year goes below the 2-year, that supposedly says there's going to be a recession. We've never had a recession without an inverted yield curve. So the bond market's telling us, hey, we think interest rates are going to fall because the Fed's going to be cutting rates. So longer term rates are lower because they think rates are going to fall. So they're happy locking in a lower number because they think rates are going to fall even more. So if you look historically, I went 6 months prior and 12 months prior. And then I'll look at the minimum over that 12 months. So you can see in the 69, I have 2 lines here. The reason I have 2 lines, the first line is a 1-year treasury because I couldn't get the 2-year treasury back to the 60s. The second year is the 2-year when it finally shows up in the 70s. All right. Sorry, it's kind of confusing. I wish I could have done the 2-year all the way back. But you can see in the 69 recession, the year before, 5 months before, that's how you read this, 5 months before the recession, the spread hit its minimum of negative 100 basis points, negative 1%. So the 2-year, or the 1-year in this case, 1 year was 1% higher than the 10-year. All right, you'll see my chart. What's that called? Negative spread is called, the initials are I, Y, C. Inverted yield curve, all right? So did the inverted yield curve do a good job of predicting that first recession? Yeah, 5 months out, it was 100 basis points. What about 73? 3 months out, it was at negative 170 basis points. In 1990, 2 months out, it was at negative 170. In 81, 6 months out, it was negative 170. In 90, 9 months out, it was only off 20 basis points. You're going to notice the spread is negative, but not as negative as you get to the 90s and 2000s. In 2001, the spread was negative 50, 11 months out. In 2007, 15 basis points, 11 months out. In 2020, amazingly, it did go negative. Because I don't know how the bond market knew we're going to have COVID. Maybe they caused it. I don't know. But the bond market somehow knew. And we actually had a negative yield curve, but not much, 5 months before the recession. All right. So every one of those recessions, the yield curve did go negative. It went negative 20 to 50 basis points in the 90s. In the 70s, more like 150, 100, 200. But also interest rates are much higher back then. So what's the average for all of these? Let's look at the 2-year. So the average is over the 12 months before, the average was for the yield curve to go negative 88 basis points. And that was about 7 months in advance. We're not negative yet, are we? So even if we go negative, the recession's probably at least 3 months, if not 6 months away.
Yeah, does it go negative, but a recession not happen? Do you see that happen?
There's been a few false terms. It's hard to say recession doesn't happen because it's like, if it's 14 months before, does that mean what's the time limit? So, and sometimes they go negative, go back positive, and go negative again. So, I mean, you can go look at it. It's so. If it goes negative, there's usually either the economy may not go into recession, but it certainly slows down. So it's definitely telling you something. So, you know, somewhere negative and 3 to 6 months prior, you'll see a negative yield curve. So the other thing I looked at was the stock market. 12 months prior and 6 months prior. You can see there it did fall during those 12 months. Here it did fall, but here it was up. Here was up, it fell 6 months prior. Here was up, it was flat the prior 6. Here was down both, but that's because the dot-com crashed in 2000, obviously. So 2001, it was negative. Here was up at 12 months, but down 6 months. The 2021, the stock market rose right into the recession. But on average, the stock market doesn't predict 12 months out. It's kind of okay predicting 6 months out, but not all that great. But one thing we do know is, what does the stock market really pay attention to? Pays attention to the inverted yield curve. So if the yield curve inverts 6 months out and the stock market sees it, that might be why the stock market's reacting. Who knows? There could be something there. Where are we today? So today, 12 months ago, still very, very steep yield curve, 12 months ago. 6 months ago, still very steep yield curve. The minimum spread we've had was 3 basis points positive. When did that happen? Today. So today we're at the narrowest spread we've had in 12 months, but it's still not negative. The stock market has been up, as you saw with Anthony's numbers. The stock market has been up the last 12 months. It has done worse the last 6. So the stock market, bond market haven't yet given us anything definitive on a recession, but we're getting close. Now, if the yield curve goes -1 or -2, I don't consider that an inverted yield curve. I consider that flat. So actually, the 2020, that -4, I don't really consider that inverted. That's, to me, is a flat yield curve. And I really don't think the bond market was screaming recession, because I don't think they knew COVID was going to happen. So you can see these minimum spreads before the recessions. They used to be huge. Now they're not quite so massive. What else could you use? Have y'all heard of LEI? What does LEI stand for? You want to predict a recession, what would you use? Leading economic indicators, right? I might be stealing Jake's next presentation, we'll see. But leading economic indicators, the month of recession, generally it's a negative number. And it actually does a pretty good job of forecasting a recession 4 months out, 1 month out. And it stays pretty negative going into the recession. All right. Here's the leading economic indicator right now. It's at 7.6%. The average is 2-point-something%. So what's the LEI telling us? We're not anywhere close to recession. So that one's not giving any indicator. Here's all the leading economic indicators here. Average weekly hours, that's getting a lot better, right? Job market's doing well. Average weekly initial claims, that's, I think we just hit a record, didn't we, on that being as low, being really, really low. So that's looking strong. New orders have been doing well. Manufacturing's been doing well. Building permits, how's the real estate market doing? Andrew, doing pretty well, right? Pretty strong. Stock market, I just showed you, and Anthony showed you, the stock market's actually been doing well recently. Credit index, I don't know that one. The interest rate spread, I just showed you that, but they don't use the 10 minus the 2. They're doing them 10 minus the Fed funds. The Fed funds still pretty close to 0, so that's still pretty wide. So I don't know this one, but the others, none of them are screaming. That's why it's at 7.6, because none of these are particularly weak. So our normal way of predicting a recession right now is saying it doesn't look all that bad, but you know, we don't always have a country invading another country. We don't always have oil prices shooting up as fast as they are. We certainly don't have 10% inflation all over again. So there's a lot of stuff going on that could certainly cause a wrinkle in all this. But you got to go with what we have, and what we have says it doesn't look extremely horrible right now. I think the inflation piece in Russia, probably the 2 pieces people are most worried about. What happens if Russia got resolved just out of sight 7 overnight? Would the markets all rally? Would oil prices tank? You know, how quick would the reaction be? You know, those kind of things. So there is the positive upside as much as there's how much, and this is always what I have to think about. It's kind of, this is the way Taylor likes to think, is what are the shocks on the upside and what are the shocks on the downside? If you were to list shocks on the upside and list shocks on the downside, which list would have more stuff in it? So can there be a shock on the downside? So to me, the biggest shock I'm worried about is Taiwan more than Ukraine, because it's kind of amazing. I think Ukraine might become a quagmire, and for quagmire resolves. Could there be an immediate shock on the Ukraine side? Putin dropping some bomb or something? Could be. But what is the world going to do if China attacks Taiwan? I think that's pretty serious. So that's on the negative side. What's on the positive side? We resolve these things. Inflation comes back down, so kind of keep that list in mind. But, so will there be a recession next 12 months? Yes, unless we don't have one. So that's my forecast right now. All right, that's it for me.
That's so sweet. Great information once again. Skip this over. There's Juan Carlos's LinkedIn again. And I will be promoting the softball tournament once again. So the link to sign up for it is on our Discord and Telegram, I believe. Definitely on our Discord. And actually, the Business Student Council has not given me any concrete details or updates on this. So sadly, it might be canceled or rescheduled, but I'll keep you updated on that. As of right now, still sign up if you can make it. It is April 9th, 10 a.m. to 3 p.m. and we're gonna play to win. So definitely, we need to represent and get our name more out there. And here's the schedule again of the current classes ongoing. A small update on this, if you're currently a lead or a teacher for the class, we did send you out, Brennan, I believe, sent out an email asking for some information and feedback of how your class is currently going, or if it's still ongoing. I know some of the people here got busy or nobody was showing up to the class, but definitely show up to the classes, y'all. They're good information and whatever fits your schedule. We have plenty going on. We do have time, so does someone want to come up and promote their class if y'all are teaching one? Yes, no? If not, I'll promote mine. Yes, come up here. So you could tell us a bit about your class, what you're teaching, and which class it is.
Hello, I'm Larissa Valdez. I teach two of the classes. One is a sector team called Consumer Staples. Basically, at this point in the semester, we're going to do a financial analysis on different companies because in the fall, we made a kind of like a stock screener. And from our data, we're now going to analyze companies based on what our list is telling us to invest in. The second one I teach is Bloomberg Market Concepts. This is a really good certification for your resume. Overall, I think Bloomberg functions and just operating it is a good way to get through the door. And, you don't have to have experience, and it's good if you just come listen and absorb whatever you can. I think one's on Tuesday, one's on Thursday. So if you can make it out, I'll be there and I'll guide you through it.
Larissa, definitely check out her classes. They're impressive, teaching too, nice. And take a quick photo, and when we do update this, we'll re-upload it onto our Telegram and Discord for everybody there. And a big announcement, we will be having the elections for next fall and next spring. So all positions will be available, a fresh start, fresh, I guess, academic year in a way. So some of the little requirements here, if you are interested in running, which I recommend, even if you don't want to or don't think you can fit up to the position, definitely still run and try your best. So on April 20th, date's up there, that's the date we will be voting and having each person who's running have their presentation and speech, a maximum of 3 minutes, and we will give you like a little reminder if you're hitting 3 minutes or not. And who's able to run exactly? Everybody who's a member and current MDs are able to rerun. And another small requirement listed there is we would like for you to have at least one slide or one visual presentation up on the board while you present and like promote yourself for people to vote for you, just because a visual presentation does speak a lot. Maximum of 2 slides. I don't think we'll need too much. But as I mentioned, all positions are available. So president, VP, treasurer. And something to note on these is president and VP and treasurer are year terms. So you're gonna, if you do get elected for president, VP, or treasurer, you'll be that position for the fall and the spring of 2023. So you will have to still be at UTSA during that time. Does anybody have any quick questions on this? I know this is the first time we're announcing it, but you're going to be able to let us know if you want to run for a certain position. by like April 19, just because we want to have everyone's presentation on time. Any questions or on Zoom? Okay, looks like we're good, but I'll be sending out a reminder, or one of the MDs will be sending out a reminder about this. I won't be letting y'all know in each week's meeting. So there's a nice little QR code up there for those who are graduating this semester for the seniors, because we do want to give y'all the stoles for the Investment Society. So current seniors, can y'all please scan this? I feel like we have a few. Colin, are you a senior? Oh, okay, surprising. Then I'm not too sure, but I'll be sending the link as well and a little bit of description for it on our social media. Now for the gift cards. Okay, the fun part. Free money. I have the 2 names already. First winner. Flores. Second one. Sorry if I said your Awesome. So y'all just come up and give me your email information. And that's about it for the gift card winners. And remember to join our network. And I do want to promote once again for y'all to apply to the UTSA Investment Society Outperform Award. It is open. I sent out the application on our socials, but if anything, you need it again, just feel free to message me and I'll send it to y'all. But the deadline is April 11th, if I'm not mistaken. So you have plenty of time. If you fit the qualifications, definitely apply. And recall that Sweet did mention in the last meeting that those who graduated in the fall, previous fall, are applicable for the scholarship as well. And that cuts it for today. We ended a bit early, quite a bit early for today, but hope everybody has a great evening. Yeah, Jake has a quick thing.
Informally, I added something that wasn't on my, I don't know where it went when I was up there. But I mentioned it and didn't say anything about it. So it was right here. Here's a heat map of brk.b, just in case you're wondering. So that's all. It wasn't up there when I originally presented, so here's that.
Nice. Okay, thank you everybody for attending. Hope to see y'all next meeting, same time, same room.